Chapter 9. Forecasting Techniques. Forecasting Techniques. Managers require good forecasts of future events. Business analysts may choose from a wide range of forecasting techniques to support decision-making. Three major categories of forecasting approaches: qualitative and judgmental techniques, statistical time series models, explanatory/causal models. Qualitative and judgmental forecasting. Qualitative and judgmental techniques rely on experience and intuition. They are necessary when historical data is not available or when predictions are needed far into the future. The historical analogy approach obtains a forecast through comparative analysis with prior situations. The Delphi method questions an anonymous panel of experts 2 to 3 times in order to reach a convergence of opinion on the forecasted variable. Example 9.1, Predicting the price of oil. Early 1988, oil price was about $22 a barrel. Mid-1988, oil price dropped to $11 a barrel because of oversupply, high production in non-OPEC regions, and lower than normal demand. In the past, OPEC would raise the price of oil. Historical analogy would forecast a higher price. However, the price continued to drop even though OPEC agreed to cut production. Historical analogies cannot always account for current realities. Indicators and indexes. Indicators are measures that are believed to influence the behavior of a variable we wish to forecast. Indicators are often combined quantitatively into an index, a single measure that weights multiple indicators, thus providing a measure of overall expectation. Example: Dow Jones Industrial Average. Example 9.2, Economic Indicators. GDP, Gross Domestic Product, measures the value of all goods and services produced. GDP rises and falls in a cyclic fashion. Forecasting GDP is often done using leading indicators, series that change before the GDP changes, and lagging indicators, series that follow changes in the GDP, indicators. Examples: formation of business enterprises, percent change in money supply M1, business investment expenditures, prime rate, inventories on hand. Example 9.3, Leading economic indicators. An index of leading indicators was developed by the Department of Commerce. This index is related to the economic performance is available from www.conference-board.org. It includes measures such as average weekly manufacturing hours, new orders for consumer goods, building permits for private housing, S&P 500 stock prices. Statistical forecasting models. Time series, a stream of historical data, such as weekly sales. Time series generally have components such as random behavior, trends, upward or downward, seasonal effects, cyclical effects. Stationary time series have only random behavior. A trend is a gradual upward or downward movement of a time series. Example 9.4, Identifying trends in a time series. The energy production and consumption. General upward trend with some short downward trends, the time series is composed of several different short trends. Seasonal effects. A seasonal effect is one that repeats at fixed intervals of time, typically a year, month, week, or day. Cyclical effects. Cyclical effects describe ups and downs over a much longer time frame, such as several years. Forecasting models for stationary time series. Moving average model. Exponential smoothing model. These are useful over short time periods when trend, seasonal, or cyclical effects are not significant. Moving average models. The simple moving average method is a smoothing method based on the idea of averaging random fluctuations in the time series to identify the underlying direction in which the time series is changing. The simple moving average forecast for the next period is computed as the average of the most recent K observations. Larger values of K result in smoother forecast models since extreme values have less impact. Example 9.5, Moving Average Forecasting. The tablet computer sales data contains the number of units sold over the past 17 weeks. 3-period moving average forecast for week 18. Spreadsheet implementation of moving average forecasting. Excel moving average tool. Data analysis options. We do not recommend using the chart or error options because the forecasts generated by this tool are not properly aligned with the data. Example 9.7, Moving Average Forecasting with Excelminer, 1 of 2. Select Smoothing from the Time Series group and select Moving Average. Enter the data range and move the time variable and dependent variable to the boxes on the right. Enter the interval, K. Example 9.7, Moving Average Forecasting with Excelminer, 2 of 2. Excelminer results. Error metrics and forecast accuracy. Mean absolute deviation, MAD. Mean square error, MSE. Root mean square error, RMSE. Mean absolute percentage error, MAPE. Example 9.8, Using error metrics to compare moving average forecasts. Tablet computer sales data. 2-, 3-, and 4-period moving average models. 2-period model has lowest error metric values.